How's it going, everybody? Thank you for being here. My name is Antonio, and you're about to watch or listen to a conversation that is general and impersonal in nature, and one that does not constitute any financial nor investment advice or any professional advice of that sort. Um, there's a longer warning on your screen right now. If you don't like losing money, pause the screen and read it. And if you do like losing money, then you might be at the right spot watching my channel. All right, that said, I'm talking to Tom Luongo here, who believes that all you need is gold, goats, and guns. Tom, welcome, and thank you for being here, sir.
Good afternoon. How you been?
I've been well myself. Cannot say the same for my continent, though. So,
Mm,
yeah. And I cannot say the same for my portfolio either. So,
mm.
I don't even know why I'm doing well, but I'm doing well, so that's good news. I had to start it this way, actually, but again, gold, goats, and guns, right? I don't know about
Right.
the other two asset classes, but gold has not been great over the last 52 weeks.
Mm-mm.
Neither have my stocks. So what's up? What's up with that?
Well, we're in a dollar bull market, and when the dollar is in a bull market, everything else at this point, and certainly the severity of the dollar bull market. When you look at the U.S. dollar index is trading at what, a 20-year high, 25-year high.
Mm.
It's something immense. This isn't a normal dollar bull market or a normal bear market correction or bear market rally. Right? This is not a bear market rally in the dollar. This is a sincere bull market that is draining liquidity from every corner of the globe. And it's something that I expected to happen because I expected
Mm.
the Federal Reserve to be aggressive in raising interest rates when they finally did decide to move back into the market. And I have a lot of reasons as to why I believe that. I believed that previously. And then when the Fed started raising interest rates, I've actually even been a little shocked that they've been as aggressive as they have been. Honestly, I'm kind of edified because Powell's acting like I would have acted had I been the chairman of the Fed, thinking, looking at the world the way I look at it, which we'll get into in a minute. But in that respect, gold is price is set at the margin by the futures market. And the futures market in gold in the West primarily is a cash settled market. It's not a gold settled market. People don't go in to buy gold futures to then take physical delivery of, 400-ounce LBMA bars, right? They go in or 100-ounce COMEX. They don't do that. They go in to hedge their dollar risk. And so, if they've got interest rate swaps or they've got treasuries, if they're worried about their dollar-based longs being, how are you going to hedge your dollar-based longs? You buy some gold, which is a short against the dollar. Buy gold, sell dollars, buy term to make dollars, and then you hedge your position. And so it's not, under these types of moments in time, all fundamental arguments about gold go out the window. All fundamental arguments about just about everything go out the window. And it's all about the dollar vortex. It's all about the dollar vacuum, for about lack of a better term. We're seeing it in stocks. We're seeing it in bonds. We're seeing it in gold. We're seeing it everywhere except for basically base commodities. Okay, which have pumped and dumped over the last year and a half, post COVID. So why is that? Well, stocks and bonds, real estate, car prices, stuff like that, they're all credit based. When the credit cycle is virtuous, when the credit is expanding, and the central banks are all expanding their balance sheets, and they're at the zero bound, and money is cheap, people buy loans, they expand credit, they pump up prices, but we haven't produced any more real commodities. We're just driving the price of eventually we drive the price of commodities up because at some point, during that time, when you're pumping up asset prices, money is not preferentially flowing into commodities during the bull market, during the asset bull market. Commodity producers are getting crushed. They're getting pushed down to their cost of production, their cost of goods sold. They're on effectively a cost plus business model. You're allowed to get cost plus 3%.
Mm.
And then that's if you look at gold stocks all through the bear market, that's the way it's been.
Mm.
And then gold hit a bottom in late 2015, went on a 5-year run up until Q3 of 2020, and since then it's been in a bull market correction. Gold's now in a bull market in every currency except the dollar. And that will also eventually change once we're done with this massive dollar bull run and everybody starts to really look at where can I protect my purchasing power.
Let's maybe
Right
dissect
now,
that though. If we sort of reverse engineer that and figure out why the dollar went up,
not hard.
relative to the other currencies, and then figure out how that's gonna turn around and make gold go up in USD as well. Can we do that?
Well, yeah. No, the important part to understand is that at some point we're going to go from having either demand pull or cost push kind of demand, supply and demand inflation to loss of institutional confidence inflation, which is the type and kind of inflation we had in the late 1970s here in the United States, where everybody lost faith in the dollar. Okay. Paul Volcker had to raise interest rates to 20% in order to get people to invest in the dollar, right? That's a hyperinflationary event. Now, when you're the world's reserve currency, it looks like what we had under Volcker. When you're Venezuela, people are starving in the streets and the money is worthless. And they add dozens of zeros after they can't print new denomination bills fast enough as the currency hyperinflates and everybody loses confidence in it. So we're not on the verge of that yet here in the United States. We're going to be the last one standing. Everybody else's currencies are going to hyperinflate relative to the dollar, and then they're going to and gold at the same time. And then after the dollar gets too strong, then the capital that flowed into the dollar is going to flow back out again because there's going to be bargains all around the world as everybody else's real estate crashes and their stocks crash and their bonds crash and everything else crashes. And then eventually the U.S. fiscal position will be such that people will lose faith there. And actually, they'll continue. They're beginning to lose faith now. And during the run up in interest rates, gold will rise along with it. And then there will be a crash. So we still have at least another, I'd say, 18 months of extreme dollar bullishness, which should keep the price of gold under control. Whether it's going to collapse from here down to possibly 1550 or 1400, or just kind of trade sideways. Relatively speaking, gold may be down for the year, but it's outperformed the S&P 500. It's outperformed the Dow. It's outperformed bonds. It may be off 8 or 9%, but everything else is off 30%. So, relatively speaking, in a credit deflationary market where prices are coming down all across the board, and those who have been hoarding dollars, which is what I've been telling my people all year long, say, look, don't get upset about this. If you see bargains in the stock market, if you see good stocks at low valuations that have been thrown out, baby with the bathwater, moment, in particular, buy them, but don't buy them with all your money. Take 20% of your cash holdings and toe dip here or there. Because, you maybe get a better bargain next week. Just because toilet paper is on sale this week doesn't mean the price can't go lower next week. So, it's not to say that stock is toilet paper. It's just that, it doesn't matter that cat food is cheap this week. You see it on sale. You go to the grocery store and cat food's BOGO. Buy one, get one free. Doesn't mean that tomorrow, but next week, it's not going to be $1 off, $1 lower than that, and still BOGO. Like we're in a bear market and in these assets, and no one knows where the bottom's going to be. And with the Federal Reserve making it abundantly clear that they are not interested in stopping the rate hikes until they have wrung inflation structurally out of the economy, which I think is a bit of a rhetorical dodge personally. But given that, their rhetoric is very clear. We are not going to stop until the job is done.
Right.
And that job is not really wringing out inflation, but restoring the world's confidence in the Federal Reserve that it is not going to be the central bank of the world bailing everybody else out as they go bankrupt.
I read an interesting blog post, by the way, from Joseph Wong. I think I'm saying the same. He's an ex-Fed trader who said that the country that blinks last, so the country that puts off QE the longest, will see the strongest appreciation in its currency. Do you agree with that?
Yeah, absolutely. The Fed, when you go back to COVID, right? This is what the European Union was trying to do. The European Union was trying to, the ECB were trying not to print COVID money for COVID relief funds. After in the United States, we had the CARES Act, which printed trillions of dollars, right? And then it was very clear, and this is my argument about Davos and Europe versus the United States, and I really do believe that those two entities are not on the same page at all. It's very clear, because if the ECB and the Fed, if the ECB was actually working in concert with the Fed, then the ECB would have printed trillions of euros during COVID, but they didn't do that. They let the Fed print all the money. And then, frankly, they installed a criminal and vandal-ridden regime here in the United States, known as the Democrats and Joe Biden. I use Biden with air quotes, to try and push through another $8 trillion worth of spending that we can't afford to trash the dollar even further, while they printed $800 billion worth of COVID relief funds. Do you see the difference? What they were trying to do was destroy the dollar by having the Democrats force the Fed to monetize a whole bunch of debt the Fed didn't want to monetize. Build Back Better was a blackmail bill. It's a whole lot of it's a whole lot of alliteration, but it comes down to it was literal blackmail by Congress. You will monetize all this debt because there's no appetite for foreign central banks to buy the Fed's debt anymore, or the Treasury debt anymore. The only ones that were left were the Fed, statutorily, and the primary dealers, the big New York banks, who were going to be on the hook for this. The primary dealers have to buy the whatever treasuries the world doesn't buy in order for them to continue being primary dealers. This is JP Morgan, Goldman Sachs, Morgan, Citibank, right? Citigroup, all that. In order for them to be primary dealers, they have to buy whatever the treasury prints that the market doesn't take up. And then what do? They buy it and they immediately turn around and sell it off to the Fed, who buys it and puts it on their balance sheet. That's the step. Well, if those bills don't ever get passed, now the Fed is free to raise interest rates, which is what the Fed wanted to do all along. Powell's been trying to raise interest rates since he took office.
How far, though? How far do they go? Did you believe that the Fed will be able to get them up in the 4.6, I guess, is being now said to be the terminal rate? Do you think they go up that high?
I think they go to 6.
Wow. Okay.
Why not?
You tell me.
If you, I mean this, if you believe, if you see the world the way I see it, and you don't have to agree with me, you're free to not agree with me, but I've been proven right so far, and so far I've been right. That's all that means. It doesn't mean that I'm going to be right tomorrow. If the Fed's not going to stop until the job is done, well, what's the job being done? The job being done is bankrupting the European Central Bank. It is getting rid of the competition for a potential reserve shift from the dollar to something else. Now, the European Central Bank destroyed the idea of it being a world's reserve, the euro being a reserve currency, by going to negative interest rates. But they always wanted to do that because the goal was to create fiscal unity and political unity in trampling national sovereignty across the EU 27 countries. And the Euro 19 countries, right? There's 27 countries in the European Union, but only 19 of them use the euro. Hungary's in, but they use the forint. Poland's in, but they use the zloty, right? So the goal in Europe is fiscal integration, is doing away with any power held by the Bundesbank, the Bank of France, the Bank of Italy, blah blah blah, blah, putting all that power within the ECB. But in order to do that, they have to have a political revolution. They have to have conditions so bad that people would actually agree to that and give it all up in order to save themselves from starving. Well, guess what? They've engineered that. And they're now screaming that the Fed is going to destroy them. Yeah, because they were expecting to be able to do this while the Fed was destroying the dollar. The Fed's not destroying the dollar. The Fed is trying to defend the dollar because they lost the political battle on Capitol Hill. They didn't get rid of Powell. They didn't install Lael Brainerd as the FOMC chair. They didn't get Build Back Better passed. They didn't tie the Fed's hands with ruinous fiscal policy by the Democrats. They got 10% of it done, but they needed far more than that. And now the chickens are coming home to roost. Now they're in serious trouble. This is exactly what I expected to happen when I saw that Biden was not able to get rid of Powell. Because Powell understood this and tried to raise interest rates hard during 2018, but he couldn't quite get away with it.
Well, something broke in 2018 too, and I've been trying to understand this, not since 2018, unfortunately, since recently.
Yeah,
But
me
as you're
either. I didn't
witnessing,
understand it in 2018 either, by the way.
but I mean,
No,
as you're
so no
witnessing right
worries.
now, it's definitely not easy for me to understand it. So I've been trying to read whatever I can find, and so I read an interesting thread on Twitter was from Count Dracula, but just written funnily, just new account. They write about macro, whatever. I didn't know it before, but so they pointed out that the Fed now earns less on its assets than it pays on liabilities, and that's a problem. But
It is.
the only realistic way to fix this in the short term would be to slow down the hikes.
Yeah, but I don't think that the Fed cares about that right
Not at all. They don't care about inflation or the labor market, none of that.
now. I don't. I just don't. I mean, they do, but they say they do, but they don't. They know they have to go through a sharp, nasty recession to bring out the excesses of the last 14 years of zero bound interest rate policy and globalists running the friggin' Federal Reserve and bailing out. They've been bailing everybody out every time the world caught a cold under Bernanke and Yellen. Powell didn't want to bail out the world under COVID. He fought it tooth and nail. He fought it tooth and nail. But he was in no position to do so because Trump, one of the biggest mistakes of Trump's presidency, was opening up the money taps during COVID. And as bad as Joe Biden is, Trump's mishandling of COVID actually set the stage for where we are today. Because Trump should have vetoed the CARES Act.
When does that change? Well, when do you expect QT to stop? Maybe in terms of time frame, but
they haven't barely even started QT. It's barely even showing up on their balance sheets, on the Fed's balance sheet. All the QT that they started in June is only just now showing up on the balance sheet because it takes about 3 months for these transactions to clear, and about another 2 to 4 weeks for them to actually show up in the Fed's report because these the treasuries are only issued twice a month. They only mature twice a month. They mature on the 15th and the last day of the month. Daniel DiMartino Booth has talked about this at nauseum. If you want to know why everybody's wrong about the Fed not engaging in QT, because she'd actually had to explain to everybody what the mechanism was. I didn't know this, but I'm not a 25-year market professional. But anybody in the know knows this, and anybody who's been studying these markets far longer than I have should know this. So I find it just disingenuous on the part of so many people that they're screaming that the Fed's not doing QT. I'm like, really? Do you call yourself a Fed watcher? Do you not understand how these markets work? You're supposed to know them better than me. You're supposed to be telling me what's going on. And now Booth has to go out there and explain to everybody, Treasuries 101. Right? It really is Treasuries 101. Right? The transactions take a long time to settle, and they're only issued on the 50th, and they're only mature on the 15th and the 1st of the month. So I mean, this is anybody who's ever traded Treasury should know all this.
Bank of England blinked, though. Bank of Australia seems to be blinking.
Sure, Bank of England is under extreme stress, but the Bank of England is not the Fed. And as I've argued strenuously for the last year, the Fed has instituted mechanisms over the last year and a half, since last June, to isolate and insulate the U.S. money markets from the rest of the world, from this strong dollar policy. We are no longer indexing our debt in the United States to an international dollar index rate, i.e. LIBOR.
Yeah.
We index our debt to SOFR, the secured overnight funding rate. And SOFR is tied directly to the Fed funds rate. Now, if the Fed raises interest rates in the United States, great. The premium of SOFR or deficit, but generally it's premium, a few basis points, over the Fed funds rate will tell you whether there's any monetary problems within the money market funds, any liquidity problems within the money market funds here in the U.S. I'm not seeing it. Fed funds rates at 3%, SOFR's trading at 3.05%. No problem there. LIBOR, on the other hand, has to now anticipate what the Fed's going to do next. And in order to avoid a rate shock, they can't just, have LIBOR be 3.05 today and 3.8 tomorrow because the Fed raised 75 basis points. LIBOR has to anticipate that, has to slowly bring the price, the LIBOR up to the new level in order to keep the banks from creating a money market meltdown in the Eurodollar markets. And the Eurodollar markets being nominally the offshore dollar markets. This is what I've been arguing. This is what I've been strenuously arguing for months now, is that the Fed is trying to regain control of its own monetary policy from the Eurodollar offshore market, from the offshore dollar markets, which create more dollars than the Fed could ever create, the commercial banking system in the United States could ever create, because the Eurodollar markets are actually far bigger than what we call the shadow banking system, or the offshore dollar markets. They're far bigger than the domestic banking system here in the United States.
What about the national debt? You mentioned SOFR. I wanted to bring that up too because I recently learned about it, so that's good. The national debt is $31 trillion. If we go to 4%, the interest rate payment will go from $300 billion to $1.2 trillion.
No, it will not. No, it will not. The old debt is issued at a fixed coupon. Very little of U.S. debt is issued as a variable rate coupon. You've got some tips, you've got some treasury, you've got some variable rate stuff, but for the most part, it's all fixed coupon. It's the rollover that's going to be ugly. There's plenty of 10-year debt out there.
Oh, like in 10 years' time, it's going to get really ugly.
Well, yeah, and we have a funding problem. We have a funding problem in the middle of 2023. There's a whole lot of U.S. debt that has to be rolled over in the middle of 2023, which is why the markets which if you look at the term structure of the Eurodollar markets and you look at and the way people are trading the Fed futures here in the U.S., they're all signaling pivot sometime in the first half of 2023 because they're all looking at the amount of money that the Treasury is going to have to roll over at a higher interest rate. And they're hoping that the Fed pivots, takes back some of these interest rate hikes in order for the Treasury to be able to issue new debt at slightly lower rates than what their current, than what the terminal rate would possibly be. The Fed is telling you flat out that they're not thinking about doing that. The Fed may pause interest rates in the first half of 2023, right? They may stop at 4.5%, 5%. And that's what Powell's been saying. And that's what Bullard's been saying. And that's what everybody's been saying on the Fed. They've all been saying the same thing. Don't expect us to give back any interest rate hikes until 2024 at the earliest. Damn the torpedoes. And too many people don't want to believe the Fed because too many people in the past still think that the rules are the same as they were in the last European sovereign debt crisis, Greece 2015, or Italy 2011.
Well, but the Fed hasn't been really trustworthy in the past either, so I can see why people don't want to believe him.
Of course, but that's because they expect that Powell is either one, incompetent, or two, in cahoots with all the bad guys. They're not wrong to think that without thinking about it. But I present to you the data of their actions because everybody who said the Fed couldn't raise interest rates like this at the beginning of the year, every Austro-libertarian, every Austrian adjacent, hard money, fiscal conservative, contrarian style market commentator, all of them, guys like me, except not quite as hardcore as I am. They're all saying the same thing. The Fed can't raise interest rates more than 1%. They'll get the 1%. They'll immediately have to give it all back. The whole market will collapse. They were wrong. Fed's at 3% and ready to go to 3.75 on the eve of an election, something the Fed never does. Which is to say, we're going to raise 75 basis points the week of the election, of the midterm elections in the United States. The Fed never does that. Even Daniel DiMartino Booth was like, no, the Fed could easily not raise rates in November because they never like to look like they're being political. And they're saying 75 basis points. You know what that means? The Fed's being political. The Fed wants the Biden administration out of office. They want them neutered. They want the Democrats destroyed because the Democrats are trying to destroy the United States. And they're done being blackmailed by a bunch of feckless commies. Got news for you, dude. I'm just going to put it like the broadest, most. I mean, I can be as blunt as you want, but that's what this comes down to. And if you listen to guys like Jamie Dimon talk, CEO of JP Morgan, it's very clear where he is on this. And who do you think's whispering in Powell's ear? Well, who controls the New York Fed? Who are the shareholders of the New York Fed?
Mm. Yeah.
The same banks that are screaming, "Yeah, no ESG. We're going to invest in oil."
Yeah,
like
I
people
saw
are
that
crazy.
clip too. It was actually that's actually pretty cool. It's priceless.
It was outstanding.
Yeah,
I was like, I never thought I'd be cheering for Jamie Dimon of all people, but I'm like, don't hate the play, I hate the game. Like it was impressive. Like, and he's only doubled down since then.
Yeah,
and
he's also said that the market could fall. I posted something about it yesterday. An easy 20% is what he calls it. So, market.
Yeah, well, I mean, but the stock market is. But was the stock market overvalued? Was everybody screaming that the stock market was overvalued? Yeah. And now everybody's screaming that they've lost 25% in beginning of a bear market. That, like, what do you want? Like, you want to be right that oh, this is unsustainable, and but at the same time, you don't want to lose any money. Like, sorry, like, what do you want? Do you want fiscal sustainability? Well, the Fed's trying to give it to you. The Fed's trying to tell Congress, I got news for you. You can't spend any more money. Not saying that just when I disagree with you earlier, Antonio, don't get me wrong. That we will have a fiscal problem in 2024, 2025, 2026 from this policy today. No argument. Is our debt servicing costs in the United States going to go up? Absolutely. What do we do about it? How are we going to get tax rate? How are we going to get tax receipts up in order to cover that? Because the only way to do this, the Democrats tax them more. Windfall profit taxes, tax the rich, tax on assets, on unrealized capital gains, the whole 9 yards. It's all dumb. The best thing to do is, as always, is to cut regulations, cut taxes, keep the money in the private sector, and let it grow wealth. And also, and by doing that, you also invite foreign capital, even though the dollar is too strong. And that way, you can then begin the process of rebalancing gross supply, aggregate supply, and aggregate demand. Just to use a Keynesian term, not that I'm a Keynesian, and get the pipelines full of gas and oil, get the diesel fuel get the refineries back online, get everything fixed, get all the combines and the wheat fields and the corn fields fixed. Let's get this stuff done. Let's get people properly working again, as opposed to, thinking that because they spend money playing video games that's part of GDP. It's not part of GDP. It's ridiculous.
It's kind of a grim subject, and I was a little bit laughing to myself because I was thinking of all the memes that came out when Kathy wrote that open letter to the Fed, Kathy Woods. Did you see that?
I did. Kathy Wood, a protege of Bill Wang of Archegos Capital.
Yeah.
A woman who was made by cheap credit is now screaming that, she's off 80%, but she's not wrong. Oops. Sorry, Kathy. Whatever. The past is littered with people like her. The one I laughed about was the UN. No, don't stop raising interest rates. You'll kill children. Excuse me. Did you stop the Ukrainians? Did you stop the Europeans from stealing the Ukrainian wheat that was supposed to go to Africa that the Russians let out of the port of Odessa? Really? Gutierrez, the Secretary General of the United Nations? Really? Huh. Yeah. Call me when you've chastised the EU for stealing grains out of the mouths of Africans.
Well, what about
the other like place friggin' jingle bells?
Where does inflation come in all that, though? Because that reminds me, do you think that times of 2-3% inflation, just incredibly low interest rates and low inflation, that's all gone? We're not going to see that for a while?
Well, yeah, we're not going to see low inflation for a while. Inflation is structural. It's cost push. We've got too much money still floating around trying to chase not enough goods.
Mm. Mm.
They've cut supply of oil, gas, food, aluminum, copper. Look, the EU Germany is shutting down aluminum smelters. Do you realize that it takes a year to bring an aluminum smelter back online?
Yep.
By the
Seems
way,
like you
a
agree with
year.
what Zoltan writes,
Yeah,
has been writing
Zoltan
about.
Pozar was absolutely on board. Zoltan Pozar was absolutely right about all of this stuff. I've been on board with so many of his ideas, and an amalgamation of Pozar, um, for me, Martin Armstrong, and a few
Danielle.
others. Like that's who I look at. I'm like, and we're all saying the same thing. You people are out of your minds.
Mm. Mm.
So
Yeah, it sure is easy to be fooled by it as a beginner market participant. It's
absolutely,
you can quickly look at these things. Like if you read through a Zoltan paper, even I understand it. If I understand it, anybody can read through it and can understand it. And then you feel like, oh, okay, this is too easy. It must be missing something. And you start
you're not
doubting
missing
yourself. At
anything.
least that's how it's for me.
You're not missing anything. The problem is that Keynesians and commies, really, I repeat myself, do everything imaginable to confuse you by confusing your terms, robbing you of your reason, and making you think, oh no, I can't possibly understand.
Mm.
No, it's because they're trying to push you to believe in something that's not true. It's propaganda.
Mm.
Okay, so never forget Yuri Bezimov and his description of propaganda, and how they can just keep telling you something that's patently untrue. But if you repeat it effectively, if you repeat it enough, and you and you muck with people's ability to process the truth, then when the truth is presented to them, they won't believe it. They won't believe. I mean, look at where we are. We have Democrats who are so trapped by their own language constructs about gender and race and everything else that they will not stand up in public and define what a woman is and what a man is.
Mm.
This is a logic trap of their own creation in their own heads.
Mm.
It's not reality.
Well, in
So
England, though, you've got sort of the opposite now with Liz Truss, and they have resorted to the option of QE again. They're now buying bonds again. They're calling it a temporary thing. I love that word, temporary. As Lobo pointed out to me, words with T. So somehow the central banks really love temporary, transitory, timely, stuff like that.
Yep.
And
Nice.
they're saying it's going to be over soon. What do you think about that, or about what's going on to
Well,
gilts?
what's interesting is I have my ideas and some theories about what I think is going on with the Bank of England. I'm going to put something out for you. And I've been saying this to my patrons, and I've said it in a couple of recent interviews. Isn't it funny that since Queen Elizabeth died and Liz Truss took power, that the two financial centers that are important in Europe that are not a part of the European Union, England and Switzerland,
Eric, yeah.
Credit Suisse, were put under attack.
Mm-hmm.
Credit Suisse, simple whisper campaign. Oh, they're going to go bankrupt over a long holiday weekend.
Didn't they
Which
pay
didn't
back the
materialize.
debt earlier or something like that?
Which did was, and then the Bank of England, the run. I don't believe for a moment that the run on UK gilts was anything other than a George Soros style currency operation. And BlackRock stood there, which Zero had wrote about. BlackRock stood there and said, "Yep, no, we're not throwing any cash into the mix. The BOE, the Bank of England, has to come in and step in." And they blackmailed the BOE. Okay, and then Mark Bailey came out yesterday while in Washington, probably after having spoken to the guys at the Federal Reserve. If I'm right about this, I may be wrong. He could have spoken to the Biden administration, and Bailey's actually working with Davos to destroy what's left of, and just working with the European Union to destroy what's the Truss government. It could be one or the other. I don't know. You can flip a coin. Both theories are correct. Either Mark Bailey is working with the Fed and he's saying, yeah, oh, by the way, at the end of the week, I got news for you, BlackRock. These are your leveraged, these are your LDI investment programs. Our pensions, you guys work it out because we're not bailing anybody out. You guys come up with the number. And BlackRock's going, yeah, well, BlackRock's got an earnings report coming out tomorrow. their stock is tracing a freaking bankruptcy chart. As far as I'm concerned, they're the next Lehman Brothers. They went all in on Davos and the ESG and DEI and all this rotten nonsense. Congress gave them access to the Fed funds rate, where they were buying up tract housing here in the United States, suburban housing here in the United States, and Blackstone at 0%. Who else is getting screwed by the Fed raising interest rates? BlackRock. Why? Because they can't get access to cheap money anymore.
Yeah.
All that real estate that they bought at the peak during COVID at incredibly overvalued prices. Housing prices in the United States are starting to drop.
It's true, but I'm also thinking
all of that on $38 billion. All of that on $38 billion worth of shareholder equity. BlackRock has $38 billion on its balance sheet. That's theirs. They control over $1 trillion or whatever in funds, but that's assets under management. Those aren't their assets. They act as the proxy for the asset owners, right? So they put people on the boards. They do this. They exercise power, but they don't actually control the funds because the funds can be pulled out. Now we have state pension funds all across the United States and every friggin' Republican state pulling their money out of BlackRock. I wonder who gave them that order.
To sort of go back to England, though, I'm thinking about their currency.
So when you think about it, you do an operation to run on the UK gilts, right? Which takes the pound down. And what's the cover? Truss and her chancellor of the exchequer, Fortin, put out a relatively politically neutral and reasonable plan. We're going to cut taxes, but we're not going to cut back spending at a time when everybody's energy bills are in trouble. We're going to have to spend some money, but we can cut taxes, which everybody knows with 5 brain cells to rub together, knows that if you lower taxes and you lower regulations and allow for investment, that you're going to raise more taxes. The IMF always says you have to do the other thing. But the other thing is destroy the country, right? Raise taxes, raise regulations, and force debt repayment. I call it German austerity. And it always comes from and that's what the IMF says. It's the wrong prescription for getting out of it. It's the right prescription to get out of it. Cut taxes, cut regulations, cut government spending. Cut it all. So Truss comes out and says, well, we're going to cut everything else, but we're going to keep the spending up a little bit. Okay, fine. So yeah, UK gilts have to drop in price a little bit. The pound should drop a little bit. None of this, the pound drops 14% over 2 days. Nonsense. That's a currency operation. That's no different than these people treating the British pound like it's the Turkish lira or the Vietnamese dong, for Christ's sake. These are the kinds of currency movements you see in countries they're trying to destroy the governments of.
Yeah. It was kind of weird, I got to admit, because they announced a tax cut. They increased spending in times of 10% inflation. Was curious.
Because at this point, none of that is going to stop the inflation. The inflation is structural. It's supply driven. It's not demand driven. We've all been inculcated into this Keynesian nonsense that if you can, central banks don't have any tools to deal with supply, right? They have all demand side tools. They have no ability to control supply.
Yeah.
Period. Even governments don't have any real ability to control supply. Supply is created by the market. But Keynesian dogma states quite explicitly that if you control aggregate demand, supply will take care of itself. And sure, during one sigma movements, when everybody has trust and faith in the currencies and the people running things and the government and everything else, yeah, you can get away with that for an awfully long time until you can't. And then once you can't, now it's supply. Now it's a cost push supply problem. You're not going to get rid of it with no matter what that's why I keep saying the Fed's not raising interest rates to deal with inflation. Fed is raising interest rates to regain the market's confidence and to regain its credibility as an institution, as a good steward of the freaking currency that is its sole responsibility. Inflation is going to just have to run its course because you baked it in because you printed so many freaking dollars. real dollars, not credit dollars, real dollars. We gave everybody $4,000 in real money. Like it was, they gave it. We already experimented with UBI in the United States. We got inflation. Like it's not hard. And refinery capacity around the world post-COVID is down 2.5 million barrels a day or more. Now we're losing aluminum, fertilizer, corn, wheat, propane, natural gas, coal, this, that, everything else. It's a supply problem. The central banks have no control over this. And if that's where capital needs to go, then you raise interest rates to stop people buying cheap iPhones and incentivizing people to buy used cars at prices that were higher than when the freaking cars were MSRP 5 years ago. Go look at the used car prices in the United States.
Yeah.
I'm looking at $20,000 trucks that are 5 years old selling for $22,000 with 85,000 miles on them.
Yeah.
These are trucks that should be trading for $8,000.
It's even true for electric vehicles, which are quicker to wear and tear, stuff like that.
The depreciation
like
curves on those are horrific.
Yeah. They'd be like 100,000 miles. They traded more than what the MSRP was, which at 100,000 miles, they're probably at half life.
Oh no, they're not at half life. They're a normal car is a 5-year depreciation curve of somewhere between 50 and 60%.
Yeah.
And the electric vehicle has a 5-year depreciation half-life because the batteries need to be changed of like 90%.
Yeah, it's true. It's true.
And like only select vehicles like Jeep Wranglers and whatnot, very specialized cars, retain more than 50% of their value over a 5-year time horizon. Very few. What good is this investment good investment in cars? Buy a Jeep Wrangler, but they're too expensive. I would not buy one in MSRP if I can get one for $8,000 off. Yeah, it's not a bad option. But you can't get them that way. Like Chrysler's, Stellantis' price on those things are off the charts. So I love Jeeps, but I won't buy one because they want way too much money for them.
They're too expensive for what it is. In my uneducated opinion, I would lean more towards older Hondas, Toyotas, Lexuses, durable stuff like that. What is it? What is this grim picture? What does it result in terms of stock? Do stock prices go back to the levels of the COVID crash, potentially lower, and then bond prices much higher? What does that? What does it look like?
We're definitely going to see higher bond prices. We're not going to see. We're going to see select stock markets do very well.
What is select energy?
Well. No, the select stock indices. We're going to have a sovereign debt crisis in Europe. We're already in the process of having it. The BOE is the first. The UK gilts are the beginning of it. We're going to have a run on Italian debt, German debt, French debt, Portuguese debt, blah, 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 all of it. It's all going to, the euro is going to go to 70 cents, dogs and cats living together. All that money that's currently in Europe, it's going to the United States. And because Europeans aren't dumb, they're like everybody else. So
the dollar milkshake is going to move. Cooking.
Right. It's not dollar milkshake theory. Like I don't believe in dollar milkshake theory. It's not bad. It's just too easy. It's only the first phase of it. Because it implies some idea that someone's deliberately doing it. No, the Fed doesn't want the dollar at 150, the US index at 150, US dollar index at 150. No one wants the US dollar index at 150.
Yeah, otherwise you're going to get the, what is it, Dutch disease? Then we had, that happened, right? That when the so the euro was not a thing, and then the Netherlands started buying oil in guilders, is what their currency was at the time.
Yes,
and they got it really expensive, so nobody was buying from them. So their farmers and stuff suffered. So if you think the currency is going higher, does that mean more suffering for the U.S. and therefore more suffering for the stock market too?
Well, no, not necessarily. Again, we're going to have capital flight out of Europe and emerging markets. We've already had some of it. I think we're going to have more. I don't think the stock market. I don't think the Dow is going to rally much here because I still think the Dow is still overvalued because we're in a credit deflationary environment. We're going to have capital flow, so we're going to see the German DAX, the FTSE, depending on how Liz Truss handles the current troubles. If she navigates them well, the FTSE 100 might actually be a good buy in about 3 to 6 months. But the CAC 40, the Italian Milan 40, the German DAX, whatnot, they're all going to get crushed. They're going to get crushed as money, but they're going to get crushed relative to the Dow. European bonds are going to continue to blow out to the upside. We'll see Italian debt at 9%, 10%, 11%.
Wow.
Okay. So some of that money will flow into tangible assets. Some people will buy gold. Some people will buy stocks. Some people will buy the most liquid and deep equity index in the world. They will buy treasuries, which will create the inverted yield curve, which we have now, where people are buying the long end of the yield curve, where the Fed has no control, which is why we have an inverted yield curve at the long end in U.S. debt, because people are rushing into buying long-term U.S. debt with a hawkish Fed, right, which is raising short-term rates because that's what they control, while long-term rates fall. But people are buying that while the Fed's still raising the whole thing. So the yield curve is kind of inverting and rising, right, at the same time. But we may have parabolic moves in European debt. When that happens, of course, the ECB will go for full fiscal integration. The EU Commission will go for full political integration, and then we'll find out whether the incoming Italian government will have any stones to stop all this. We'll find out. I don't know that they will or they won't, but it's definitely a wild card scenario. But we'll see the U.S. equity markets do relatively well, outperform. They may not rally while everybody else's stock indexes will lose 30% or 40%, depending on how vicious this credit deflationary cycle gets. Right? We may see, the CAC 40 drop 40%, but the Dow will drop 15%. And then at some point, there's going to be a slingshot in the Dow when everybody starts bailing out of everything else. And we're going to see everybody pile in to the deepest, most liquid equity indices in the world. At some point, people are going to plow into Apple at $125, $130 a share. Got news for you, they are. Doesn't matter what Apple's forward guidance is. At that price, Apple has enough cash on its balance sheet to cover the stock price because the company is ridiculous. Go look at Apple's got a bigger balance sheet than most of the countries in the world.
It's true. It's true. Oh yeah, I do these things where I would weigh big companies' balance sheets relative to some of the sectors, and when you start weighing them to some of the energy sectors, it also starts getting ridiculous. So in that regard, by the way, what about energy commodities, oil, coal,
natural gas? I like all of them. I think they're all going much higher.
All of them?
OPEC is not stupid. OPEC knows exactly what they're doing. So all of the industrial metals market, coal, natural gas, all of that stuff's tied to the oil price.
Sure.
Because you need oil and diesel fuel to run all those businesses. Period. On-road diesel, off-road diesel, you pick it. Doesn't really matter. But, you want to pull gold out of the ground, you need big freaking pickup trucks. Big freaking dump trucks. Guess what? Those big dump trucks run on massive amounts of off-road diesel.
But the industrial metals are also tied to economic prosperity.
They are.
So how do they go up if there's turmoil?
But they do, but not now in a credit deflationary environment. So, no, I'm not saying that we're going to see $6 a pound aluminum or anything, right? But we're definitely going to see a lot higher than $2 a pound aluminum. And even if aluminum doesn't move from here, relatively speaking, aluminum is outperforming everything else. At this point in time, you cannot be thinking in terms of quote unquote the return on your money, but the return of your money. Classic Mark Faber line.
I have no idea.
You just want to make sure that you can get back what you put in and maybe make a little bit along the way. Now, gold is going to eventually do well because at some point, everybody's going to call the Fed's bluff on interest rates and blah, 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 blah. We're going to wind up in a Volcker scenario and that's fine because the U.S.'s fiscal position is going to start to collapse. Congress is going to be very resistant to changing their spending habits. Washington is definitely, and Europe are desperately trying to get the United States and NATO to fight a war against the Russians in order to justify more military spending. In order to, well, okay, so if we can't get you to do $6 trillion to fund the Green New Deal, you're going to spend $6 trillion on World War III. It's always a $6 trillion problem. Like they're the $6 trillion extortion men. It's always the same thing. You have to start looking at these things as extortion rackets. The Fed is the key to understanding all of this. The Fed and the New York banks are off the reservation. They are not down with the Great Reset. They are not down with global communism. They are not down with the end of commercial banking. They have no incentive to allow Klaus von Commie Schnitzel and the rest of the WEF and European freaking commies like Guy Verhofstadt and Ursula von der Leyen and the rest of these freaking assholes to destroy the world. They just don't. They have no incentive for this. And they're acting the type. They're going, yeah, we're not doing that. And they've got all of they pitted their minions versus Klaus's minions. And there's a fight happening on Capitol Hill that unlike anything you've ever seen. And all of Klaus's minions are dementia patients and are 85 years old. Okay? They're all Dianne Feinstein and that drunk Pelosi and Joe Biden and Patrick Leahy and all these people who are just dead. Steny Hoyer. Like, are you kidding me? You're going to fight Ron DeSantis in Florida? Really? 44-year-old ex-judge advocate general and freaking Marine? Oh, really? You're going to fight that guy? I'm putting my bets on Ron DeSantis, Tulsi Gabbard, and any number of these youngins any day of the week and twice on Sunday. Because look, it's just and if they've got if Diamond and company have their back and Powell and these guys are all in their 60s, they're all in the prime of their lives. Like Diamond's not 75 or 80 years old; he's in his 60s. Powell's what, 62, 63, whatever, however old Powell is. He's not that old, but he's certainly running rings around the octogenarian set in the Senate. And they're all going to be out of power by 2024. Every one of them.
Yeah. Well, I think Powell's like 70 though.
Is he that old? Okay, yeah. Well, he's still got plenty. He's still got 4 or 5 years to do the job.
By he looks 60 though.
He'll be done. What's that? He's got plenty of time.
Yeah. He looks 60 though, to be honest. So
he does. He looks great. That's why I like. Yeah, he looks good. I mean, I'm only 54. I don't like Powell looks better than me. Then again,
I was just about to ask you how he was in school because I just assumed he went to the same class. I'm just kidding.
Fair enough.
No, just kidding. You look fine. What are you doing with your money then? Gold, goats, guns, and energy?
Well, gold, goats, and guns for me is a metaphor, right? I don't know if I explained this last time I was on the show. Gold is your savings. It's your pool of real savings. It's not an investment. Gold miners are an investment because you're taking on risk. They're an industry. You've got capital risk, you've got investment risk, you've got time risk, you've got all that stuff. Gold, you've got currency risk. It's savings. Bitcoin is savings. Okay. They have no other uses in the marketplace other than as money. So they're savings. They're an alternate currency. You're hedging your currency risk. So from a portfolio perspective, you find assets out there that can act like bonds that are effectively savings, that produce you good income, high yield with low downside. So they're in the right industry, right? Producing high yield with good balance sheets and good long-term prospects. And then your goats are your metaphor for industry. And that's where you put your money in. That's where your blue chips come in. Once you've got a pool of those guys, then you can buy some industries. Now you can take some now you can take some time risk. Now you can take some investment risk. Now you can start thinking, okay, what sectors are going to work really well? I have my people in a lot of energy. I've got my people in, gold mines. I've got my people in I got my people all over the place, actually. You'd be surprised in some of the stocks that I have people. I'm not going to talk about them here because that's what the Patreon's for. It's what the newsletter's for. It's what my business is. And then guns are just your hedges, are your defensive plays against your core portfolio strategy. Right? So if I'm wrong about the dollar, then Now, if I'm right about the dollar, right, then you go short the euro.
What about diversification? Before I
I am
ask you how you
fairly
think.
diversified across a whole lot of different sectors, but I'm
Yeah, that's what you
concentrated.
said. But what
I'm
about
concentrated. I'm concentrated in things that do. I'm not gonna like. There's a point where like I don't give away all the keys to the candy store.
sure?
Like
Okay.
fair. I mean,
Okay.
fair enough, right?
Yeah.
But think about the areas. Is all of real estate going to be bad? No, there are sectors of real estate that always do well in bear markets, but they aren't where people think they are. And some of them are in private equity. And I can't, in a retail investor newsletter, I can't advise people into those things, but I can talk about those sectors and then say, hey, by the way, for those of you who are accredited investors or high net worths, you might want to think about these types of things. Go look for private placements in these sectors. If you give people a sector or an example stock in a sector that you think is interesting, right? Not necessarily the best or all the stocks in that industry. There are a ton of gold stocks that are out there that are better than the ones that are in my portfolio. But these are the ones I like for the reasons that I like them. And I tell everybody, I tell my people all the time, these are examples of the types of assets you should own. If you're going to buy a gold mining stock, it should have this kind of balance sheet, this kind of business model. Do you buy a royalty company or do you buy a miner? And what portfolio should the royalty company go in? The royalty company should go in the gold portfolio because it's a yield play. The strict miner pulling ounces out of the ground should go in the gold portfolio. It's an industry play. You're playing, it's a derivative off of energy or whatever. So, excuse me, I got an itch on my nose. I'm not a Coke fiend. I swear to Christ. So, I'm not Jacinda. I'm not Jacinda Ardern. I'm not a Coke fiend.
This has been fun. Yeah, I always enjoy talking to you. I went through the topics that I wanted to talk about. Didn't even have to look at my notes too much. It was a good talk. Is there something that you wanted to talk about, but I failed to bring up?
We're on the verge of a sovereign debt crisis. Europe is being pushed and pulled, and is being pulled apart in two different directions. With the Russians and energy on the east, you've got the Fed and dollars in the west, and Europe committing ritualistic suicide in the middle over ideology, thinking that they can transition off of fossil fuels before everybody else does. They're wrong. When you understand that, and that's the big threat, that's the tail risk, where you put your money should be pretty easy after that.
Hmm. That's a great message.
Because this time, the Fed's not going to be there to bail them out. The Fed's at war with them. Hmm. And if I'm wrong, you and I will never speak again because I'll have to go get a real job because I've staked everything on this.